And we move on to our deep dive segment. We're taking a look at the empire that is Berkshire Hathaway as well as Warren Buffett. And we're joined in studio by a very distinguished gentleman who Simon has informed me he's known for over 20 years. Interestingly enough, the gentleman has been a professor for the last 25 years. Talking about Professor Adrian Saville, who is currently a professor at the Gordon Institute for Business Sciences. Prof, thanks so much for taking the time, because I call you that officially. Other people call you Adrian, but thanks so much for coming through.
Thanks, Jimmy.
I saw yesterday.
Just for the record, I've known Adrian for 25 years. From when, it was Bay Hill.
It was Bay Hill Capital, yeah.
Bay Hill Capital, but we're still both in our 20s.
What a fantastic
Just
memory.
for the record, I knew him since we were toddlers.
And you only found out today that he's a professor.
No, I've known for ages. I just didn't know the hierarchy. Doctor,
it's such a weird thing, right?
Guru, there's words.
Yeah. Before we get into the deep dive segment, I saw something on socials yesterday. Someone in the family is doing exceptionally well. So you're very happy, very chuffed with
proud
that.
dad. Yeah, you
proud
picked up
dad.
on. So my daughter's in third year of her degree. Yeah, to sort of overshare right out the blocks. This is a young woman who 3 years ago I was dragging, kicking and screaming through matric, and stuttered over the line, and man, she has absolutely blossomed. Hey?
Matric is a bearing of nothing.
So, here she is banking first-class passes in the final year of her psychology degree, just doing superb. I'm so proud.
Awesome.
Yeah.
I, for one, don't want to be the child of an academic, because the expectations are just out of this world, especially when your father is one of the leading academics in the country, possibly in the world. But all the best to your daughter.
I'm married to an academic.
It's not an easy...
You just know where you sit in the hierarchy of the household.
As long as everybody knows the truth, right? The deep dive. This was an interesting one to think about as well, because I imagine as a professor, you would have done multiple case studies as part of your MBA classes and all of that. And the Berkshire Empire has to have come up at some point as some form of a model case study or something that you can draw valuable lessons from.
Sure. One of my areas of fascination in trying to figure out the success of people and enterprises, the firms and the people that we adore and celebrate, often suffer from what's referred to, Phil Rosenzweig refers to this as the halo effect, that you look backwards and you explain successes by coincidence rather than by design. And this is the stuff of celebrity books. And Berkshire Hathaway is a great case in point. If you asked Buffett to start again right now, if you gave him the start point and his initial capital and said to him, do it again, would he be able to do it again? And if he is, then we're in the world of skill. If it's not, then we're in the world of luck. So absolutely, Berkshire Hathaway, that's a great example of the consideration of skill versus luck. And, to put it into statistical terms, imagine lining up, a couple of million monkeys in front of typewriters and letting them randomly press keys. Eventually someone would type a word, or one of the monkeys would type a word. No, it's a well-trodden thought experiment in finance. And I don't think Buffett's going to listen to this, so we're probably safe.
We'll send it to him.
Is he a monkey in front of a typewriter, or is he truly someone who, is skilled? That's the fascination with this incredible investment record.
That's quite interesting, because as you say that, I think about a Naspers, a Kursbecker, where you hit 10 cents. Would you be able to hit?
But this is what the full by randomness is also about.
Exactly. That's exactly the point.
It's that. And how much of it, and I look back at my career and I can identify points, and it's a long story, but short version, I'm here today because a photographer went to Pietermaritzburg and the person wasn't there, so he stopped at Boters Hill, took a photo of me, and I ended up on the front page of the Sunday Times business section. My website went from no one knew it to 100,000 views, and there's those moments, and I can look back and identify and say, that hadn't have happened, where would I be now? And how different? And maybe I'm still here, just in a, but that immediately, then the phone starts ringing, and suddenly Simon Brown's not just some hippie in KZN buying cement stocks.
Simon, there's actually a brilliant Charles Dickens talks about moments in your life where there's just some golden link in a chain that happens, and were it not for that, where would you be now? If when you make this point about Buffett, it sounds like, well, what have you done? You're just grumpy. But here's an amazing stat. If you take Apple out of Buffett's investment decision and he doesn't buy Apple, generally actually underperforms the S&P 500.
Wow.
With that one decision.
That is crazy.
And now he took the decision, right? He took the shot.
Yes.
But
what if he had it?
But it's same. I mean, again, I look at my portfolio. Capitec at 20 Rand was a defining difference to my portfolio. And I remember at the time, I mean, it was, you don't realize it then. So it's hindsight. And of course, all the risks that come with it. But there's another point to it, Adrian. If we go back to when he got Berkshire Hathaway, which of course was a bankrupt textile company, actually.
Yeah.
Could he replicate it in 2024? Not from his skill set, but from the market. Is the market got the patience, that quarterly go-go? I suspect that the 60s and 70s and certainly the early 80s, I mean, the 80s got crazy towards the end, was a different and more patient market. And maybe I'm completely wrong. I was not there. I'm not sure. But, Buffett had that luxury of permanent capital, but patient permanent capital, perhaps more than anything else, that I don't know if it exists so much anymore.
There's certainly a confluence of circumstance and things that have sort of aligned, whether you're Warren Buffett, whether you're Simon Brown, Adrian Saville, Jimmy Moyaha, there are things that kind of come together at a specific point in time. How do you then go from things just relying on things just coming together to actually making the skillful decisions? Because as you said, Adrian, it's luck and skill, but the skill part of it for Warren Buffett did come at some point. I mean, we take Apple as another example. He's just offloaded almost 400 million of those same Apple shares, and the timing of that ahead of what could potentially be the biggest financial recession we've seen since the 2008 recession. How do you then get from it's just skill or it's just luck to there's skill to it?
Maybe Buffett's herding. Hey? if you look at inflows into money market funds have hit record highs, $6.5 trillion sitting in money market funds in the United States. So Buffett's joined them.
Well, hey, when you've got a 50-year track record of beating the S&P, maybe this is how you sort of lock in your legacy.
Quit while you're ahead.
So in running a permanent capital vehicle, Buffett essentially, the single task that he has is almost that of a CEO of capital allocation. And I agree with Simon's suggestion that you have to wonder, or his curiosity. You have to wonder if you gave Buffett 2024 as a start point, if the market would be, investors would be sufficiently patient. The great, however, is he's got a permanent capital vehicle, so investors can get as impatient as they like and sell the Berkshire stock. He'd then be sitting with the same amount of NAV to allocate. So when you've got a permanent capital vehicle, you can not disregard, but you can really worry substantially less about the anxiety, the frustration, the impatience of the market and your investors. And is Buffett a shrewd capital allocator? Now, here we can start to go in the direction of skill and ask how many has he got right? And his win ratio, his success rate is overwhelmingly, in the positive. And that then puts my grumpiness in the box and says, just relax, Adrian. It wasn't just Apple that he got right.
Would the success, or would that win ratio be the same if he had a different investment philosophy? Because Warren's philosophy has always been never hold more than 10 stocks or so in your portfolio. Always keep a very specific concentration.
Brilliant.
And that also inherently reduces the amount of chances you're going to get it wrong. So if you get 7 out of the 10 right, you've got a 70% win ratio. But if you get 7 out of 100 right, it's a very different conversation.
See, so here, Jimmy, is where we get into the business of figuring out if it is Buffett that was just lucky and now we write books about him and celebrate him, because how many non-Buffets have failed building concentrated portfolios, and there's no books about them. We don't hear about. They've just died quietly,
or just tracked the S&P. I mean, maybe they just bumbled along and did okay.
No remarkable success. You don't hear about them. They don't get invited to vodcasts.
They're not topics of discussions on podcasts. Yeah.
So that's the statistical fooled by randomness that Simon refers to earlier. Where we're stuck is, from a statistical perspective, we don't have a big enough data pool. He hasn't done this for long enough for us to be able to say with statistical confidence he's skilled. So we have to here agree to be fooled by randomness. But
I like that.
Where I'm convinced of his investment approach is the high conviction, high concentration. Just before we started recording, we were talking about the portfolio I've been running since 1996. And it started its life as a highly, highly diversified portfolio, increasingly concentrated, and today consists of just 13 stocks. Lucky 13. But, I can name those stocks. They make up, 7%, 7.5% each of the portfolio, so very high conviction, and it's had fantastic returns over 25 years.
And that's a great point, because I look at my portfolio. I mean, I was learning markets and stuff in the 90s. The logic was, well, firstly, you bought Anglo, you bought Pick and Pay, and then you decided what to buy after you'd put those two in. And portfolios were 30, 40, 50 shares. And these aren't funds, these are portfolios. And I don't know who or what I read. And I want to say Peter Lynch, but I'm not sure if I'm right about this. One up in Wall Street, who said, no, you've got to go concentrated. So I sit on I typically sit at around about a dozen shares at any one. I've got ETFs and I've got Reg 28, but in my little portfolio, it typically sits at about a dozen, because that concentration, if I own 50 stocks and one of them's Capitec, no one notices. So then what am I doing? Then
just it doesn't matter.
Go buy the ETF. And I love myself ETFs, but if you're out there and saying I'm a skilled stock picker, then it is around that concentration. And I think that is also something you get from permanent capital. I'm thinking Chris Seabrook from Sadvest. That permanent capital gives you the luxury to step away from herding.
I mean, it's as if you crept into my head. You stole my thought. So, Chris Seabrook at Sadvest has compounded capital at 22% per annum since
insane.
The late 1980s. This is just an off-the-charts record. Now, maybe Chris would listen to this one. There's a better chance that Chris would listen to this one. But if we said, is he lucky? Has he misstepped in some places? Absolutely.
Sure.
He's made mistakes. But his win ratio is overwhelmingly better than the average. And that speaks volumes about shrewd capital allocation, astute skill. Pete Viljoen at Astoria, I think, is a similar case in point. And what's striking about those pools of permanent capital is Astoria is trading at 50 cents in the rand, and the net asset value of Sadvest, 110 rand a share, trading at 75 rand a share, compounding at 22% per annum. You're being given gearing for free.
Yeah, you're buying rands for 70, 50 cents. I mean, which is just ridiculous.
So in conclusion, when we look at, obviously, I guess we should probably conclude on the permanent capital side of the conversation and draw it back to what we've seen from Warren Buffett and the Berkshire Empire. The current Warren, the current Berkshire, 2024, liquidating Apple shares, sitting on $277 billion of cash, more treasury notes than the US Fed themselves, the guys that issue the instrument. What do you even do at this point? I mean, you've got permanent capital. Your son runs a farm. He actually herds. How do you now ensure that everything you've done over the last 50 years is sort of transferred into something meaningful? Because $300 billion, we round it off, call it $300 billion in cash could just disappear if the thesis and what was in Warren's head and what was in his mind, if that isn't translated into, I almost want to say, multiplying yourself into the world, so to speak, so that we have better investors going forward. 2024 is breeding a different type of investor, certainly one that doesn't look at, oh, I'm going to be doing this for 50 years like Warren did it. There's a lot. Because there's a lot more technology, there's a lot more advancements, there's a lot, you have quicker.
But you're going to live longer.
Fair enough.
So why not 50 years?
Yeah.
You know, Jimmy, let's finish with a Jimmy thought. Jimmy Carville, is the advisor to Bill Clinton when Clinton is on his election campaign in the 90s. And James Carville has a lovely, lovely quip. He says, in my next life, I'm not coming back as a fantastic baseball player or as a cardinal archbishop. He says, I'm coming back as the bond market because you can intimidate everyone. It's like there's a Buffett thing here, right? He's done with equities. Now he's coming back as the bond market or the short end of the bond market. But if you look at valuations on markets at the moment, and here, how long can you be wrong? But 3 stocks in the US are worth more than all of China. Something just doesn't square here. And, to confirm my thesis, I'd like to say that Buffett's calling it that way also. These valuations just don't make sense.
So we're in line for a reset.
Yeah, but don't hold your breath there, because I'm old enough to know that these resets can take time.
Yeah,
they can take time.
Forever in a day. Yeah.
The investment thesis that is Warren Buffett and the Berkshire Empire. That's the deep dive. We'll leave it at that.